This is Ron Diamond, and you're listening to the Matt Balaker podcast.
Good day, fine people out there. Thank you once again for tuning in to the Matt Balaker podcast. If you want to earn extra brownie points, please like, subscribe, and share. I'm quoting Shaquille O'Neal, or maybe it's Aristotle, when it says, you are what you repeatedly do. So today's guest is certainly a wonderful human being because he's a repeat guest on the show. He's a longtime investor and entrepreneur. He's the founder of Diamond Wealth. He represents over 100 family offices ranging in size from 250 million to 30 billion in assets. Please welcome Ron Diamond back to the program. How you doing, Ron?
I'm terrific. How are you?
I'm doing well. It's always, I mean, it was great to have you on initially. It's even better to have you on again. And there might be a few people who didn't tune in to the first episode. So can you share with them, what got you interested in investing in the first place, Ron?
Well, first, I have a question for you. There's a large delta between Aristotle and Shaq.
I would, yeah.
So you don't know which one that came from?
What's that?
You don't know who the quote came from as one of the two?
No, it is from Aristotle, but when Shaquille O'Neal won his MVP award,
got it.
He famously held up the trophy and called himself the big Aristotle and says, you are what you repeatedly do. Greatness is not a singular act.
Got it. Okay. Yeah, I thought that came more from Aristotle.
I'm not a philosophy major, so I could be wrong.
Yeah, no, I've always been, since I was a kid, interested in investing. So, I learned it, and I went to Northwestern. I studied economics, and then I went to Wall Street. I worked at Drexel Burnham, and kind of cut my teeth on Wall Street there. So that's kind of how I learned about it. But I've always had an interest in investing.
And lots of people who have interest in investing are really good at kind of being employees, but it takes a different skill set to hang up your own shingle and become an entrepreneur. What motivated you to effectively start your own thing, Ron?
The company I worked for went bankrupt, so it made my decision relatively easy. So my first job was at Drexel Burnham, and for people who are old enough in your audience, Drexel was like Goldman on steroids. So that was with Michael Milken, and it was the most lucrative firm on Wall Street by a long shot. And there were a whole bunch of things that happened, and one thing led to another, and ultimately Drexel went bankrupt. And I was in the room, I remember vividly. I was 24, and I didn't have any stock options, but I had a great job. Mm-hmm. I'm in the room with these people in their 60s and 70s and 80s, and I'm seeing men weep in the late 80s or early 90s. That didn't happen on Wall Street, and a lot of these people lost most or all of their money. And my takeaway from that was that I would always be loyal to people, always extraordinarily loyal, but never to a company. Because if this could happen to Drexel, this could happen to Goldman, this could happen to any firm. And because of that, I started, my plan was just to stay at Drexel and hopefully, run one of the divisions one day and do that. Yeah. But that changed. And so I came back, and my father was sick. So I moved back to Chicago, and I started a hedge fund. I had no intention on doing that, but I was really disillusioned with the way in which the firm went bankrupt, and it was just not good. So, I started a hedge fund in 1990, which was relatively early, but it was really because Drexel imploded, not because I had a huge desire to be an entrepreneur.
Well, I guess adversity is the best teacher. If you didn't take a class to start a hedge fund, there was circumstances outside of your control, and you've since evolved. You've become a leader in the family office space. And can you share with our listeners, what is a family office?
It's a great question. I gave a keynote at Stanford about 5 years ago, and I had 5 family offices, and I said, what's a family office? I asked them, and I had 5 completely different answers. It's fascinating because, family offices it's a new phenomenon, right? And the model itself actually doesn't work because only 25% of family offices make it to the second generation, and 10 make it to the third, and 5 make it to the fourth.
Well, sorry, why do you think the attrition rate is so high?
Mostly dealing with the ego of the founder.
Okay.
No, that's true. So basically, 68% of family offices were started since 2000, and half of those were started since the crash. So this is a very new industry.
Mm-hmm.
And it's very fragmented, and it's very siloed, and it's very inefficient. And people, the word family office gets bantered around all the time. I've got a family office, and I'm starting a family office. I work for a family office. In my opinion, most family offices, most of them shouldn't exist. So what happened is, initially, family offices in the U.S. you can go back probably the Rockefellers, the Vanderbilts, the late 1800s. You go to Europe, it's, centuries. But the family offices that started here, the way we hear, your listeners are listening to the word family office, think about it since 2000. So it's a very new phenomenon. In order to have it make economic sense to have a single family office, you need a minimum of $250 million, in my opinion. And I'm fairly certain I'm right. Because if you reverse engineer it and you do the math, if you're under 250, if you sell your company for $100 million, that's still a tremendous amount of money.
Right.
But it's not enough money to have a single family office. And that's why multifamily offices were created. So multifamily offices are simply, you're sharing the expenses with other families. It could be 3 families, it could be 5, it could be 200. But that way you're not paying the whole cost. So in order to, if you do the reverse engineering, you need $250 million minimum to have it. Having said that, a lot of family offices have, or people who call themselves family offices have much less than that, and that's fine. I make zero judgment. If people made money, they could do whatever they want with it. I'm just telling them from an efficiency standpoint what they should do.
Okay, and you're talking about efficiencies, and one of the reasons why we want to have you back is you had a brilliant post on LinkedIn where you talk about how the philosophies in investing are different for family offices during a recession. And I have some questions of that, but can you kind of give the overarching theme of your post, please?
Sure. Well, look, the biggest advantage that family offices have is patient capital. And so what happened when I started my career in the early 80s, venture capital and private equity, that's really when they started really exploding. Mm-hmm. The reason they took off is because I ran a hedge fund. If you're running a company and you've got to report to a guy like me every 90 days, it's very hard to run a business, right? And that's what public companies have to do. They have to report to analysts or hedge fund managers every 90 days. And it's really not the most efficient way to do it. So the venture capital and private equity took off because the model was 2% covers the overhead and 20% I only make money if you make money. So the interests were much more aligned. You didn't have to worry about every 90 days. And it was a better model. So from the mid-'80s until now, and it's continuing to increase, the private equity and venture capital markets have exploded because it was a better model. The problem, in my opinion, is that many, not all, but many of the private equity firms, it's become an AUM game, and right. the funds are too big, and they're making a lot of their money on the 2% rather than just the 20%. So I think I don't remember if in the last podcast I mentioned it, but I had a close friend who did a roll-up of logistics companies, and he needed 150 million, and they gave him 500. He said I just needed 150, and the place
keep the change.
Well, the placement agent literally came to his apartment in New York and wrote down 2% of 500 equals X, 2% of 150 million equals Y. What am I missing? And my friend, who was a bit incredulous, said, what you're missing is if I do what you want me to do, there won't be a fund two, because I can't deploy the other 350. I can only deploy 150 efficiently.
Mm-hmm.
That's a microcosm, in my opinion, of what's wrong with the industry. Again, not all, but many. So these $10, $20 billion funds, it changes the model on how they have to invest, right? Because they've got so much capital, and because they're getting a 2% annuity every single year, they're going to be incented to be a little bit more conservative in their investments.
Oh,
and
sure.
they're also less companies where I think you can really create the alpha in some of the smaller companies, which they're too big to do. So it's a fascinating time, and I think we're only in the third inning in the evolution of family offices.
So what do the fourth, fifth, and sixth innings look like?
I think you're going to see them become less fragmented, less siloed. I think you're going to see them work more and more together. Right now, there's no. You can go to PitchBook, you can go to Preqin, you can go to these organizations, and you can see who are the top 100 venture capital firms, who are the top 100 private equity firms. There's no such list for family offices, and family offices, by definition, for better or for worse, they want to be private, which is fine.
Sure.
It's their prerogative. But if that's their prerogative, then no one is going to know. So how are the smart people going to find the rich people, and how are the rich people going to find the smart people? So I think what's going to have to happen is you're going to see some changes, and we're starting to see that happening. But the fourth, fifth, and sixth inning is going to be where family offices are going to invest alongside other family offices, where if Tim Callahan, for instance, was Sam Zell's partner, brilliant guy in real estate, if it's a real estate deal, they'll let him lead that deal. Greg Wasson was a former CEO of Walgreens. If it's a healthcare deal, he would probably lead that deal. And I also think you're going to see a lot of these family offices merge into multifamily offices, because that's where they belong. Post-crash, pre-COVID, everything went up. So you could have invested in private equity and venture capital and real estate, credit and Bitcoin, the stock market, everything went up. So the mantra was, well, I don't need these experts, right? So why should I pay fees? Because I'm making money. And it worked.
A high tide raises all boats kind of thing.
Correct. It worked until it didn't. So now as we head into recession, which we are, a lot of these deals are underwater. So now for the first time, remember, these family offices, 68% started since 2000, half started since the crash. Those started since the crash have only seen good things up until about a year ago. So now we're in a period where a lot of these deals are they're losing money. They're underwater. And they're realizing that there's a skill set to doing private equity or venture capital or real estate. I talked to the guy who runs Carta. The average Series B investment is down 50%, and the average Series C investment is down 75%, 12 months, year over year.
Wow.
Real estate is, with interest rates have gone up exponentially, are really getting depressed, especially in the office market. So a lot of these deals, the direct deals these families did in order to avoid fees, they're losing money on. And I think they're going to have a moment where they're going to realize and reevaluate how they do things. And it isn't until you start losing money when you have the aha moment. And I think the aha moment is here.
And how does this aha moment involve a shift from doing, you call it private individual deals, to perhaps investing in other funds or pooled assets?
Most people don't have the look. It's all relative. So I did a podcast with Tony Pritzker and Paul Carbone, who's a friend of mine. They, in my opinion, the Pritzkers, they've institutionalized it. They're kind of one end of the spectrum. They can compete directly with Blackstone and Carlyle, but Paul's got a team of 50 people who helps to analyze the deals and vet the deals, and they've got the capital structure, and they could do it. That's one end of the spectrum. Michael Dell's family office is like that, Sergey Brin. So there are some like that. But 95% of the family offices do not have the infrastructure. They do not have the infrastructure doing it. And being that it's such a new industry, when the market was going up and up and up, it didn't really matter because they were still making money. As we head into recession and they're losing money, they're realizing they didn't increase the infrastructure, and they can't or they shouldn't be doing it themselves. They don't have enough team play. They don't have a deep enough bench to do it. So I think how it'll play out is some of the family offices will pivot into becoming multifamily offices. Some of the family offices will go to the Pritzkers of the world and work with them who have the sophistication. And you're going to see a lot of things play out. But what's fascinating is this is happening in real time. And, every bank, every law firm, every accounting firm is trying to get into the family office market because that's where the money is. But the issue is that many of the family offices, it's not that families all of a sudden wanted to start managing money and investing.
Yeah.
The reason that they did this is that in 2008, when the market crashed, a lot of people lost confidence and trust in Wall Street. So the first, second, and third thing family offices want to know is, can I trust you? And the fourth thing is, what's your track record? Give me your 1, 3, 5 year drawdown, et cetera. That's flipped with institutions. So I think it's a complete relationship business. And the reason that a lot of the banks and the law firms and the accounting firms are having trouble getting into some of the family offices, they're leading with their expertise. And that's not how to do it.
Look how smart I am, family.
You need to lead with relationships, and relationships take time. And intelligence is a commodity, integrity is not, and that's what the families are looking for.
I mean, you bring up lots of important points, Ron, but I mean, say there is a banker or there's someone who legitimately feels that there are good opportunities that family offices should look at, but this person doesn't have the contacts. I mean, should he just give up? I mean, I guess, how do you develop these relationships time efficiently?
How do you develop relationships with family offices?
Yeah, but understanding that you might not have 10 years to cultivate it. Like what advice would you give to someone who might have good opportunities that they think are worthwhile to presenting to family offices, but lack the relationships?
It's very simple. Figure out a way to add value to a family office. Period. End of conversation. It's not complicated. There's way, the first thing I do when I meet with a new family office, I might be looking at a really attractive real estate deal or private equity deal that I found, and it looks really good, and I'm going to put my own money in. I won't bring that investment to them. The very first thing that I like to do when I'm meeting other families is introduce them to other family offices, right? Because by introducing them to other families, again, and I'm out of the equation, they want to meet other family offices. So that's something that a value add that I can do, because just because they're uber wealthy and they sell their company for $1 billion doesn't mean they might be connected with people in their industry, but it doesn't mean they're connected with people not in their industry. It doesn't mean they're connected with people in different geographic locations. So by me connecting them with other people, and I don't have an agenda, I'm just like, you should talk to this person and they can tell you what they've done right and where they've messed up. That's a value add. And figuring out ways to add value to these family offices, that's the easiest way to do it. And, I don't have an agenda. And it's very easy for people to figure out ways they could add value to these family offices, but you have to give first before you try to get. And the more you give, the more you will receive at the end.
The golden rule applies to so many aspects of life. So well said. And earlier in this episode, Ron, you talked about patient capital. Oftentimes venture capitalists are not known for their patience. How would you quantify patience? Is it a 7 to 10 year holding period, or what is it in your opinion?
Well, it's a good question, and there's not a definitive answer as far as time frame. But what it is there's not a definitive time when you have to sell. So private equity and venture capital, the way they're incented is they're incented. The partners are incented to flip companies every 3 to 5 years. That's how they're paid.
Mm.
That's not necessarily the best model. So let's look at a company that you buy a widget company, you buy it in year one. What's happened in the market is you see private equity firm A sells it to private equity firm B. They hold it for 3 to 4 years. They hold it sold to private equity firm C, and then maybe another time. So basically, over a 20-year period, you could have seen this change hands 3 to 4 times with it from private equity firm 1 to 2 to 3 to 4. If you look at the taxes and the transaction costs that are involved every time you sell the company versus a family office who could buy a company from day one, hold it for 20 years, let everything compound, not have to worry about those taxes being paid, not have to worry about the transaction costs, it's just a much better model. And the problem now that we're in is there's no question if you've got a company and it's second, third generation company, and you want this company to continue and there's a legacy involved, I would always sell it to a family office. I wouldn't bring it to a private equity firm because that's not how private equity firms are incented. The problem right now is that many of the family offices aren't as sophisticated as the Pritzkers or the Dells, and they don't have the infrastructure. So we're still not quite there yet. Mm-hmm. I think over the next 3 to 5 years, more and more families will get there. And as more and more families get there, the people who are selling their widget company are going to now learn about family offices and perhaps use them as an alternative. Having said that, if you're looking to sell your company for the highest bidder, family office will never win. Private equity will always overpay because they've got X amount of capital and they have to place it. So they have two options when they have the capital. If they have a $5 billion fund, they either deploy the capital or give it back.
Right.
They don't give it back ever. So they're going to deploy it. And what we saw in the last, 2-3 years ago is they were investing in companies and way overpaying. In my opinion, we would see companies from family offices that we love. They're great companies. We would be interested in buying them, but then a private equity firm would pay 2x or 3x for it. For like, it's a great company, but it's not worth that, and they overpaid for it. So I think there's not as much alignment of interest, in my opinion, with the private equity firms there are with family offices. But having said that, again, private equity is still a phenomenal industry, and I invest in private equity, and it's been done extraordinarily well, as is venture capital. But I think that it's starting to change, and as family offices become more efficient and less siloed and less fragmented, family office will never replace private equity or venture capital, but they're going to disrupt them in a very similar way that private equity and venture capital disrupted the public markets in the early to mid 80s.
Interesting. During recessions or recessionary type times, people are often reluctant to put money to work, even though it makes sense. I think as Peter Lynch says, invest when there's blood on the streets, or I'm paraphrasing. How do we get over, or how do people get over that psychological roadblock to put money to work when seemingly things are crumbling in front of us, Ron?
Well, family offices have a tremendous amount of dry powder right now because they weren't overpaying for deals in the last couple of years. So now is a time when a lot of family offices are investing. So I think now is a really good opportunity for family offices. So a lot of these real estate deals where people develop these real estates, and it could be multifamily. It doesn't matter what it was. They can't refinance. They're underwater. There's huge opportunities to invest in real estate, even though real estate, certain sectors have really gotten hit hard. There's also certain parts of private equity and venture capital that have been crushed. So whenever that happens, as long as you have the dry powder, which family offices do, now is a good time. So family offices in general are being very proactive in select ways, looking for ways. And this is the way you can make most of your money, is when everything's down or many things are down, and then you invest. That's really the best philosophy. And with patient capital, family offices can and are doing that.
Basically, don't overpay, have dry powder, and be patient.
Which is something you would tell your fifth grader. And it's not complicated, but the problem is that Wall Street, and I came from Wall Street. I think alignment of interest is really, really the key. And I think that family offices in general, their interests are much more aligned with the companies than some of the other firms. And that has to do with how they're incented.
Okay. And why would a family office invest in a fund versus just an individual company?
Because they don't have the expert. Most family offices should invest in funds because they don't have the bandwidth or the expertise or the bench, enough people to manage it, right? So, and they don't necessarily, even though they might have sold their company for $250 million, if you're going to buy 5 or 6 portfolio companies and these need to be fed every 3 to 5, fed money, it's a tremendous amount of money. So most family offices, in my opinion, and you're going to start to see that because they did direct deals, and the direct deals all worked until they didn't, which is like a year ago. And now I think you're going to see a pushback, and you'll see less families doing direct deals, which many of them shouldn't. Now, if you're the Pritzkers, it's a better model. You should, but there's very few firms like that. So most of them are going to now realize I'm better off paying the fees and investing with people who are experts in what they do. And the families, if they made their money in real estate, they should continue to focus on real estate, just outsource the rest of the stuff. They made their money in tech, focus on tech, outsource the rest of it. That's starting to happen.
Right. It's the adage of focus on your core competencies and then outsource the rest. How is due diligence different for family offices if they're examining a fund versus a direct deal?
Well, I mean, if they're examining a direct deal, most of them don't have they don't have the bench to really examine the direct deals. And because this is such a new industry, it didn't really, a lot of families thought they were smarter than they were because they were making money. And if you're making money without paying fees, this is great, right? Mm-hmm. But now that we're in a recession, they're realizing there's a reason the private equity and venture capital real estate guys make a lot of money. It's hard, it's a skill set, and they're really, a lot of people are really good at what they do. You can't go into venture half-ass. I mean, if you said, well, I'll put a little money in a venture, and you do direct deals, you're going to get clobbered.
Right.
You can't do real estate. You can't do private equity unless that's your core focus. And I think that's what you're starting to see play out. So I think I think you're at a bit of an inflection point right now. And I think the 4th, 5th, and 6th inning are going to be family offices starting to realize this is a business. Many of them don't put in the hours, time, effort, or thought that they did into their company, which made them the money. And now they're starting to have to. Some do, but many don't. And now I think you're going to see people pivoting, realizing either A, this is a full-time business and I'm not going to lose money on this, and I have to focus 110% of my time, or I'm going to pivot to a multifamily office and just invest the way in what I'm good at.
Yeah. And there are going to be some family offices and just some people in general that will always favor the public markets. There's more liquidity. It's easier to get real-time valuations. Obviously, there's all sorts of risks with private markets. Why would a family office or anyone really invest in private companies?
More lucrative. So the bottom line is that historically, the private markets, private equity, venture capital, real estate in general, it's a much more lucrative area than investing in the public markets. Personally, I just have money invested in index funds, the public market. I think when I ran my hedge fund, it was much easier to create alpha in the public markets. Today, I think it's very difficult to create money in the public markets, to create alpha in the public markets. I think you can do it in private equity and venture capital and real estate and credit and special situations. So that's why they do it. And family offices, again, it's called the illiquidity premium. you're getting paid a premium to be illiquid. So for these deals, the negative is you're locked in for a period of time, but the positive is that in general, many of them, of the best performing ones, they've outperformed the public markets, and there's fewer and fewer public companies. And then also, companies are going public much later. So the alpha that's being created is being created while the companies are private. So there's a whole slew of reasons why family offices invest in the private markets.
That's a great answer. And what are some catalysts to creating alpha in the private markets?
I think that a lot of it, to me, it has to do with relationships. There's a lot of really smart people and a lot of really, in different areas, different industries. But if you're connected and you've got relationships, let's just say in real estate or in private equity, and you've got a sphere of influence in that, those people will come to you. So it's almost like a club deal. And I think that the more relationships that people develop with other family offices, typically the better the deals they're going to see once they really evaluate it. So it is complicated, but it's really simple when you think about it.
I like that. It is complicated, but it's very simple. And earlier this week, Ron, I was chatting with an investor who was working with a company that went public, and he regrets that they were public. And I was curious. I was like, why? He's like, there's too many costs. There's more accounting costs. There's more legal costs. There's just more kind of disclosure costs. What would be a hypothetical example of a company that you would say should just stay private, or at least remain private for a much longer time than a company in a different industry?
Well, look, the problem is that once you're a public company, it is your company, but it's not, right?
Yeah.
The shareholders own it. And you've got a board of directors and you've got to report to somebody every 90 days. You're managing your company totally different. And if you're an entrepreneur and you're self-made, which these entrepreneurs are, and then all of a sudden you're a publicly traded company, they're out of their comfort zone because they don't like to be told what to do, when to do it, and the fact that every 90 days they have to have earnings and managing earnings and things like that. So I understand why, in your example, the person went public and was unhappy that ultimately they did it. It's not just a question of cost; it's a question of culture. It's a totally different animal, and more companies are staying private longer and longer. And the number of private companies are going like this, and the number of public companies are going like this. And I think that's a trend that's going to continue.
Interesting. Well, thank you, Ron. You've talked some about the fourth, fifth, and sixth innings of family offices. Now that we're kind of, finishing this episode, what do the call it seventh, eighth, and ninth innings look like in your opinion?
I think ultimately you're gonna, and again, this could be 7, 10, 15 years down the road, but the family, you'll see a fewer number of large family offices that are having other family offices invest alongside them. And I think that they will have plenty of cash. They'll have plenty they'll have a very deep bench. They'll know what lanes to stay in. So whether it be, this is a family office that they're experts in private equity, or they're experts in real estate or venture capital or whatever it is. And I think that, again, it will not replace the private equity or venture capital, but I can promise you family offices are starting to, and ultimately will be majorly disruptive of these private equity and venture capital models. And as a result of that, the private equity and venture capital firms are going to have to pivot, not the family offices, and work more like the family offices with patient capital. We saw it with Sequoia, with one of the funds they created, and you're going to see that in the next 5-10 years. So I think ultimately there's always going to be a market for private equity and venture capital, but I think that ultimately the first choice, based on alignment of interest, for many people is going to be go through a family office.
Go through a family office. Very nice. When it comes to family offices, what are you most optimistic about?
Well, it's not alpha. It's more a question of a philanthropy. So, my kind of North Star is, I look at, my dad passed from prostate cancer at 57. My first boss was Michael Milken. And if you look at what Milken did for prostate cancer, you and I and all the male listeners will die with, but not of prostate cancer if we live long enough.
Exactly.
And if you look at what Gates did for vaccines, I would argue he did more than the government, right? So my kind of North Star is, you can't run a philanthropy exactly like a business, but you can run it more business-like. And there's no way we would be as far along as we were with the cure of prostate cancer if Milken just put $100 million into the American Cancer Society and said, focus on prostate. He built it like a VC fund, $2 million here, 500,000 here, 3 million here. And that's how he did it. And same thing with Gates with the vaccines. So I think why I'm so optimistic is I think a lot of the family offices are going to really solve, not all, but some, and hopefully many of these real world problems that we have. And it's not just about these. Remember, the family offices, it's a family. They're people. They don't have shareholders to report to. And, right now, there's impact investing. It's a trend, but a third of the family offices are doing impact investing now. It's going to be roughly 50% in the next 3 to 5 years. It's being driven from the younger generation up rather than the older generation down. And again, when I was a kid, I never looked at the back of a can to see where it was made or, how they treated their employees. It wasn't that I was a bad person. I didn't have the internet, right, to look. Yeah. Now my daughters buy a pair of jeans, but before they do, they want to see who makes it, how do they treat their employees, do they have any bad things written about them. And so the companies are forced to do, so this matters a lot to people. So impact investing, philanthropy, these are things that, one of the reasons I'm very optimistic about family offices.
Well, now I'm even more optimistic. So thank you, Ron. And where can people learn more about you and what you're up to?
Well, I have a podcast. It's familyofficeworldpodcast.com. And then I'm fairly open on LinkedIn. So I'm happy to, work with, talk to people there. But again, I'm not looking for anything. We invest alongside about 100 single family offices, anywhere between 250 million to 30 billion, and I invest alongside them. So I'm not really looking for anything, but I'm happy to, add value. And I try to write content once a week or so on LinkedIn, and hopefully the podcasts are, hopefully informative as well.
Oh, he's a great LinkedIn follow. He's a great LinkedIn follow, folks. So, Ron, thank you so much for joining us once again on the Matt Balaker podcast. Really appreciate it.
Thank you, Matt. Pleasure being here.
Thank you for listening to this episode of the Matt Balaker podcast. To learn more, please check out mattbalaker.com and encourage your friends to like, subscribe, and share. Really appreciate it.